Good morning and welcome to TOITOI Japan Market Radio, April 5, 2026. I'm your host reporting from Tokyo, bringing you the latest on Japanese markets for global investors tracking Japan exposure. Today was a holiday in Japan, so the market was closed, but there's been significant news flow out of the Middle East with direct implications for Japanese assets. Let me bring in our portfolio manager to walk us through what happened and what it means.
Thanks for having me. So yes, the Japanese market was closed today due to a public holiday, but as you said, there's been a lot of activity on the geopolitical front that matters a great deal for Japan. We're looking at escalating tensions in the Persian Gulf, specifically around Iran and Kuwait, and there's also been movement on the OPEC Plus side regarding production agreements. All of this feeds directly into Japan's energy security picture, given how dependent the country is on Middle Eastern crude. The key question for global investors is how this translates into risk for equities, the yen, and JGB positioning when Tokyo reopens.
Let's start with the most urgent headline. Kuwait Petroleum Corporation reported damage at some of its operational units following what's being described as a drone attack attributed to Iran. This is obviously a significant escalation in the region. Can you break down what this means specifically for Japan?
Absolutely. This is a critical development because Japan sources roughly 80 to 90% of its crude oil from the Persian Gulf, and Kuwait is one of the top suppliers. Any disruption to production or shipping infrastructure in that region directly threatens Japan's energy security. The immediate concern is twofold. First, whether this attack signals further escalation that could disrupt the Strait of Hormuz, and second, whether Kuwait's production capacity is meaningfully impaired. For Japan, which is still navigating post-pandemic recovery and the BOJ's gradual monetary normalization, oil price volatility is a major policy variable. Higher oil prices feed directly into inflation, complicate the BOJ's exit strategy, and pressure the current account.
So when Tokyo reopens, how should investors be thinking about positioning across asset classes?
It's a mixed picture. On equities, I'd expect initial weakness, particularly in energy-intensive sectors like utilities, automakers, and chemicals, because higher input costs squeeze margins. However, if oil prices spike and the yen weakens as a result of import cost pressures, export-oriented sectors might actually see some offset. On balance though, if we see material supply disruptions, the Nikkei and TOPIX are likely to face headwinds. On the yen side, there's a tug of war. Normally geopolitical risk drives safe haven flows into the yen, but elevated oil prices hurt Japan's current account and put downward pressure on the currency through increased import costs. So the net effect really depends on whether risk-off sentiment dominates or whether energy inflation concerns take over. For JGBs, we'd likely see an initial flight to safety bid pushing yields lower, but if crude prices spike and inflation expectations rise, that could reverse quickly and complicate the BOJ's policy path.
Staying with the energy theme, there's also been an OPEC Plus development. Reports are saying that OPEC Plus has agreed in principle on a theoretical oil output increase, though the wording is notable because it's described as nominal given the practical constraints from Iran's situation. How do you interpret that?
It's an interesting signal. The fact that OPEC Plus is even discussing output increases suggests they're trying to signal stability and avoid further tightening supply, which is actually constructive for Japan. However, the term theoretical tells you that Iran's paralysis and the broader geopolitical instability mean this agreement may not translate into actual barrels hitting the market anytime soon. For Japan, as the world's third largest oil importer, this reduces near-term upside risk to oil prices, which is positive. Lower energy costs support corporate margins, ease inflation pressures, and reduce the import bill. All of that is beneficial for the current account and gives the BOJ a bit more breathing room.
So if this agreement were to actually materialize, what would be the market impact in Tokyo?
I'd say modest positive tilt for equities, particularly energy-intensive sectors like chemicals, steel, and utilities, because lower input costs improve margins. The yen might see slight positive pressure as well, since moderating oil prices reduce the import bill and support the current account, which is a structural yen support factor. though I'd emphasize the effect would be marginal given the theoretical nature of the agreement. On JGBs, the direct impact is minimal, but if lower oil prices ease inflation expectations over time, that could provide subtle downward pressure on 10-year yields. The market would read that as reducing the urgency for BOJ tightening.
Meanwhile, there was also some positive news on the operational side. Shipping data showed that a tanker loaded with Iraqi crude successfully passed through the Strait of Hormuz. Iraq is one of Japan's top 3 oil suppliers, so this seems like a stabilizing signal. How important is this transit data for Japanese investors?
It's actually quite significant. The Strait of Hormuz is the world's most critical energy choke point, and any disruption there would have immediate and severe consequences for Japan's energy security. The fact that this tanker transited successfully indicates that, at least for now, crude flows are continuing normally despite the geopolitical tensions. That's a modest positive for Japanese markets because it reduces near-term inflation pressures and energy cost risks. For equities, this is supportive, especially for trading houses and utilities that are directly exposed to energy imports. It also benefits energy-sensitive sectors more broadly.
What about the yen and JGB implications from this stable transit?
On the yen, I'd say neutral to slightly positive. Easing energy supply concerns reduces pressure on the BOJ to tolerate yen weakness driven by import cost inflation, though the impact is marginal since crude prices are still range-bound. For JGBs, this is slightly positive pressure on yields. Stable energy supplies reduce stagflation risks, which could allow the BOJ more flexibility in policy normalization. If energy stability persists, the market might start pricing in modestly tighter monetary conditions, which would put upward pressure on the long end of the curve. But again, this is a gradual theme, not an immediate repricing.
So pulling all of this together, we've got escalating geopolitical risk in the Gulf on one hand, but also some stabilizing signals on supply flows and OPEC+ coordination. How should global investors with Japan exposure be thinking about the next few sessions?
I think the key is to watch oil price action and shipping data very closely. If crude spikes materially, that's a headwind for Japanese equities and complicates the BOJ's policy path. But if oil remains range-bound and supply flows stay stable, then the market can focus on domestic fundamentals, which are actually relatively constructive right now. The yen is the trickiest call because you've got conflicting forces between safe haven demand and energy-driven current account pressure. My base case is that geopolitical risk premium keeps a floor under the yen, but it won't appreciate aggressively unless we see a broader risk-off move globally. For JGBs, I'd expect volatility, with yields likely compressing on risk-off days but facing upward pressure if energy inflation concerns ease and the BOJ signals more normalization.
And just to be clear for our audience, when Tokyo reopens after the holiday, what are the first indicators you'll be watching?
Oil futures, obviously, and any updates on Kuwait Petroleum's operational status. I'll also be watching shipping rates through Hormuz and any BOJ communications, especially if we get comments on energy-driven inflation. Equity-wise, I'd focus on sector rotation, whether defensives outperform or if we see risk on buying in exporters. And of course, the USD/JPY reaction will tell us a lot about whether the market is pricing energy risk or safe haven flows.
Great context. So to recap for our global investor audience, Japan's market was closed today, but Middle East developments are front and center for Japanese assets. We've got geopolitical escalation around Iran and Kuwait, which threatens energy security, but also some stabilizing signals from OPEC+ and ongoing crude transits through Hormuz. The net impact will depend on how oil prices evolve and whether supply disruptions materialize. Investors should be prepared for volatility when Tokyo reopens, with mixed implications across equities, the yen, and JGBs.
Exactly. And I'd just add that this is a reminder of why Japan's energy dependence remains a structural vulnerability. For long-term investors, it's worth monitoring not just the immediate geopolitical noise, but also how Japan's energy transition and diversification strategies evolve. That's going to be a key theme for the next several years.
Thank you for that comprehensive breakdown. If you're tracking Japan's markets and want daily insights like this, please consider subscribing to TOITOI Japan Market Radio. We'll be back tomorrow with the latest on Tokyo trading. Thanks for listening.